How you calm down. How are you guys doing today? Today's lesson 34, gravitational macro forces, or just macroeconomics in general, and wrapping up this bad boy in a nice pretty little bow and moving on to mental analysis. So today we're going to talk about the large cap things that matter macroeconomically in the stock market. So today we're going to start off with the business cycle. I'm going to show you how to find the business cycle, where we are, because if you took economics in high school or college, you know we go up, we come back down. Hopefully, we come back down and then reverse before we get lower than the last low. And we go up and down, up and down, up and down, kind of in this trajectory, right? It's never gonna be a perfect line, but we go up and down. That is determined by GDP, growth, inflation, deflation, what month it could be, interest rates. All these things do matter. We'll discuss those today as well. We're then going to touch on GDP. It is important to know how the country is doing and how they're producing things. If we're producing more things, and folks are buying more things, that means more than likely more stocks are going up than down. If we have massive GDP and we're producing more, that's a good sign for the stock market. I'll show you how to find that and how that can help you with timing the market, which I never really for. I don't think you should time the market, but you can find a good deal. Well, we'll find it. We can find a good momentum play. I'll show you how to find that too. We're then going to look at monthly growth because not every month is created equally. I think some folks think, that when I start trading in October, November, December, and January, it was all peanuts and nuts. But then, here comes August and September, and it's not so fun now, is it? So sometimes different months have different results. I'll show you how to find that information as well. We're then going to discuss inflation. I don't think deflation is really an issue yet. If we do have massive deflation, none of this matters anyways because they're just going to fire everybody, whatever it may be. But we'll find how to find the inflation numbers, usually 2 to 3% on average a year, but there's some that it does go up higher and that could be bad for the economy. I'll show you how to find that as well. And then we're going to look at interest rates, how we look at TNX on TOS or just look at it online. I'll show you how interest rates lowering is good for business and how it goes up is bad for business in the stock market in general usually. So that's all lessons for today. Then we're going to talk about wrapping a nice bow on this, where you should go from here, your goals, your strength, your weaknesses, your edge, and we're going to go on to mental analysis. With that being said, lesson 34, let's get into it. So the first thing we're going to discuss is the business cycle. If you never took economics in high school, that's totally fine. I don't think this is a complicated idea, but it's such an easy step you can take to understand what we're looking at. We're going to have at times of expansion and growth and times of contraction and pullbacks and companies kind of sizing back down. Now, there's a lot that goes into this. You got, again, inflation, you got deflation, you got GDP, you have growth, you have regulations, all these types of things. We're not really going to dive into that because you don't have to be that precise to find we're in the business cycle that we are. But if we're in an expansion phase or an early expansion phase compared to like a recession or early recession phase, you're going to have more green in the market. And then when we have pullbacks, that's when you start to look for long-term holds. If we're going to have a big old recession, you buy those little baby dips accurately. If you have like $10,000 and we're starting a recession, give it a month, let it continue, buy $1,000 that month, buy $1,000 the next month. And eventually your average is going to be great when it starts to come back up. So that's how I use contractions myself. But we're going to look at how you can find where you are on the business cycle right now. Let's check it out. So this is stockcharts.com. This part is free. I do pay for the RRG graphs we're going to cover. It's $30 a month. It's not that expensive, but again, it could give you way more money in return. So I think stockcharts.com is great. So this is the sectors we're going to talk about today. I'm not worried about this currently, but again, you can see, energy and financials are the best. Utilities and staples and discretionary are on sale. So you could buy these long and then buy the momentum of these. But here's what we're looking at is the stock rotation model. What we're going to be looking at is the orange line compared to the blue line. Let's check. So the stock market, which is going to be the orange line, does not perfectly line up with the blue line. We're usually ahead, right? So if the stock market's going up, it's because we have good deals and we have some recoveries coming. And then when we start selling off, it's because we know that we're peaking on the business cycle. So you want to find the blue line. That's where we are, right? Okay, we want to find where we're on the blue line. And then you can find the sectors above. We have technology, discretionary, comm service, industrials, yada, yada, yada. Where on the blue line we are, we'll line up to the orange line, and then those are the sectors you want to kind of focus. We can see energy and financials are green, and so is real estate. Now, it's odd because energy and financials are kind of pretty far apart. So again, this is kind of goofy given COVID, but you can see we're probably somewhere in this range. More than likely, we're probably peaking right now. But I have a good website to show you real quick. If you're coming off of a world disaster like COVID, these charts will get kind of goofy, but I have one website for you to show you where we are according to some banks. I'll show you. So this is institutionalfidelity.com. They actually give you where in the business cycle they think we are. Now it's not perfect. I'm gonna show you real quick. That usually you're gonna do this. You're gonna go Q1, Q2, Q3, Q4, Q1, and you're gonna go up and down this line perfectly. Watch what happens when I hit United States. Q3, 4, 1, 2. Because of COVID, it's kind of goofy. So you can see, usually you would assume you're gonna go, let's see what China's doing. 3, 4, 1. See how they're kind of confusing too? Either we did Q3, all of Q3 was this to Q4 to Q1, and now we haven't moved. So it's not a perfect system by any means, but this website usually will show you where we are. It's a really nice tool to use when we don't have a horrible pandemic, right? In itself, we discussed inflation as well, and we can see inflammatory pressures right equals high. Inflation does get high during contractions. Economic growth does dip during high inflation. And of course, relative economic performance with GDP and growth is over here. So again, you can see during expansions, inflation is low and growth is high. And during contractions, inflation is high and growth is low. Pretty obvious. Off this website, again, you can then pinpoint what sectors you want to go and what kind of market we're probably in. Again, it's according to this website, right now we are in early recovery to now what looks like to be an expansion. Now we're in Q2 right now. So I think we're kind of going closer to an expansion with Q3, 4, 1, 2. So we're waiting on Q3. Right now we're still recovering, which is going to put us somewhere right about here, which lines up with what energy is doing so well. Materials isn't bad. Staples are getting hammered. Healthcare is not bad. So again, these are all green. So we're probably somewhere over here, right? We're probably near comm services, industrial, materials, energy, doing pretty good. We're probably right about here. This matters because now we can pinpoint what sectors are going to be doing the best, which we'll get to later in this lesson, and also which ones to avoid. If you're going to be long-term investing, though, you have to think about it this way. If I'm going to be buying long-term investments, I don't want to buy ones that are high. So I'm not going to be buying energy, materials, and consumer staples right now, or industrials right now. I'm buying what's on sale. And what's on sale right now is staples and utilities the last 200 days. So I can, I'll show you RRG graphs, but you can mess with this for free. You can change this to 100 days if that's how long you usually hold. You can see these are all down, so these are not bad deals. Last 25 days, 35 days, we can see this matches up pretty well, right? These are green, energy's low. So depending on how long you want to hold a stock for, will show you. Energy is probably a great deal right now, so is materials. But if you're holding for like a few years, like we'll do 300 days just to see, you want to do like a longer term hold, these four are going to be the best to buy for a deal. These are probably a little bit overbought right now. So I have a whole lesson on this already on my free YouTube. You can check that one out. But we'll cover indexes and sectors in a minute. But to simply find where in the business cycle we are, this is what I do. It's great to show you inflation rates. It's a great place to start to show us, hey, maybe we are expanding. I should go and try and buy some green stocks, do a little bit quicker holds. And then when we start contracting, it's like, this is where I'm going to start being less active, trying to get some long-term holds, buy some dividend stocks on value, whatever it may be. But to find the business cycle, that's how I do it. The second thing is GDP. Again, if you never took economics, which is totally fine, GDP is gross domestic product. It's how much as a country we produce. So the higher the GDP, the more stuff this country produced and the more stuff this country bought. That's a good thing. When GDP is going up, it means that we're selling more, we're buying more, we're more active. The economy has been in good situations where probably inflation is low, interest rates are low, so businesses can borrow more to expand and to have good growth stocks. When GDP is up, that's a positive thing for the stock market. When it's down, it's not really good. This does have its limitations on some stocks, though. If you're gonna be buying like EDU or that's his ticker, by the way, or like BABA, which is another ticker. If you're buying Chinese stocks or Japanese stocks or European stocks, yeah, American GDP does matter, but if their GDP is trash, not saying that it is, but if it is trash and you're going off American numbers, that's not going to translate, right? So make sure when you're buying stocks, you know what sector, what index, and what country they're from. I have a great website. Let's check it out real quick. So this is CEIC data.